The stock market crash of 2021 was a sudden and severe drop in stock prices that occurred in late January and early February of that year. The crash was caused by a combination of factors, including a surge in interest rates, a slowing global economy, and concerns about rising inflation. The crash began on January 25, when the Dow Jones Industrial Average dropped by more than 1,000 points in a single day. The S&P 500 and Nasdaq also experienced significant declines. The selling continued over the next several days, with the Dow falling by more than 3,000 points by February 3. The cause of the crash was a combination of factors. One of the biggest contributors was a surge in interest rates. The Federal Reserve had been keeping rates at historic lows to support the economy during the COVID-19 pandemic, but as the economy began to recover, the Fed began to signal that it would start to raise rates. This caused investors to become nervous about the potential impact on the economy, and many began selling their stocks. Another factor that contributed to the crash was a slowing global economy. Many countries, including the United States, were still struggling with the economic fallout of the pandemic, and there were concerns that the recovery would be slow and uneven. This added to the uncertainty in the market and contributed to the selling. Finally, there were concerns about rising inflation. With the economy recovering and interest rates rising, many investors feared that inflation would also rise, which would erode the value of their investments. This also contributed to the selling. The crash caused widespread panic and many investors lost significant amounts of money. However, it is important to remember that the stock market is inherently volatile, and crashes are a normal part of the market cycle. In the months following the crash, the market began to recover, and by end of 2021, the market had regained most of its lost. Despite the significant impact of the crash, it's important to remember that the market has always recovered from past crashes. In the months following the crash, the market began to recover, and many stocks that had fallen during the crash began to rise again. As the economy continued to recover, companies began to see their profits and stock prices rise again. In the aftermath of the crash, many people were understandably hesitant to invest in the stock market. However, it's important to remember that investing in the stock market is a long-term strategy, and short-term fluctuations should not be the sole determinant of investment decisions. In conclusion, the stock market crash of 2021 was a sudden and severe drop in stock prices that had a significant impact on the broader economy and individual investors. However, it is important to remember that the stock market is inherently volatile, and crashes are a normal part of the market cycle. It's important to keep in mind that investing in stock market is a long-term strategy, and short-term fluctuations should not be the sole determinant of investment decisions. It's recommended to have a well-diversified portfolio and not to panic during market downturns. The stock market crash of 2021 also had a significant impact on the broader economy. As stock prices fell, many companies saw their value decrease, which led to a decrease in investment and hiring. This, in turn, led to a slowdown in economic growth and an increase in unemployment. Many individual investors also suffered significant losses during the crash. Many people had invested in the stock market as a way to save for retirement or other long-term goals, and the sudden drop in stock prices left them with much less than they had planned for. Some investors panicked and sold their stocks at a loss, which only compounded their financial losses. It's important to have a well-diversified portfolio and not to panic during market downturns.